You know, I've always believed that simplicity often beats complexity, especially in investing. The more I've studied the markets, the more I've seen that chasing trends, timing tops and bottoms, and jumping in and out of every hot ETF rarely leads to long-term success. It just leads to exhaustion. So in this video, I'm going to share 4 Fidelity funds I personally find compelling right now. These aren't recommendations, just my thoughts and ideas from my own research and experience. Each of these funds plays a different role. One brings innovation and future-focused growth. Another delivers income and multi-asset stability. One helps expand my portfolio beyond US borders. And the last taps into a sector that's been helping me build wealth. In a world where we're constantly bombarded with investment ideas, it's refreshing to come back to a strategy that focuses on quality, balance, and long-term durability. So if you're someone like me who wants to build wealth steadily, without having to monitor your portfolio every day, I believe you'll find this video really useful, especially if you watch until the end. Let's kick things off with the first Fidelity fund, a fund that puts me at the front lines of innovation while still giving me the kind of broad exposure. Fund number 1, Fidelity NASDAQ Composite Index Fund, FNCMX. This has really opened my eyes to what long-term and innovation-driven growth can look like. If you're an investor like me who loves to invest in the future, this is one of the most straightforward ways to do it. FNCMX tracks the NASDAQ Composite Index, which includes more than 3,000 companies, mostly from the tech world, but also spanning biotech, digital commerce, AI, and even green energy. What I personally love about this fund is that it doesn't just only give my portfolio exposure to the big names like Apple, Microsoft, and Amazon. It also includes smaller, more agile companies that are working on some of the most cutting-edge technology today. So it's not just about the present leaders, but also the next wave of future leaders. For me, that feels like smart positioning, like placing your portfolio at the intersection of what's working now, and what could work even better 5 or 10 years from now. Now let's talk about performance. Historically, FNCMX has been a strong performer, and it makes sense. Over the last decade, it's delivered an average annual return of roughly 15%. That's impressive, especially considering that's over a long-term window where we've seen tech crashes, recoveries, COVID-related volatility, and rising interest rates. It's ridden the ups and downs, but stayed on a strong upward trajectory. That kind of performance didn't happen by accident. It reflects the power of innovation and the benefit of staying invested in sectors that are fundamentally changing how the world works. I mean, just think about how different life looks today compared to 10 years ago. A lot has changed. We now have advanced smartphones and artificial intelligence. A fund like FNCMX captures the businesses behind those shifts. This fund pays me once a year. Another thing I like about this fund, it's cost-effective. Unlike some actively managed tech funds that charge high fees, FNCMX is passively managed. That means it mirrors the index, keeps costs low, and avoids the constant trading that can eat into returns. Less friction, more focus. Also, from a tax efficiency standpoint, Fidelity funds like FNCMX tend to generate fewer taxable events, which is great for investors holding it in a taxable account. That's not a substitute for good tax planning, of course, but it's a nice feature for investors who want a set it and let it grow type of strategy. Again, this is just how I'm thinking about positioning for the future. I'm not saying this fund is right for everyone, but in my case, FNCMX gives me a lot of what I'm looking for. Diversification, long-term growth, access to high-performing sectors, and a structure I can stick with through thick and thin. Let's move to the second fund, one that adds a layer of income and balance even when markets get bumpy. Fund number 2, Fidelity Strategic Dividend and Income. After looking at growth-focused funds like FNCMX, I started thinking, what about stability? What about income I can count on even when the market gets rocky? That's when I began exploring the Fidelity Strategic Dividend and Income Fund. And let me tell you, the more I looked into it, the more I realized this fund isn't just some boring defensive play. It's a well-thought-out mix of income-producing assets that actually complement a growth-heavy strategy really well. Let me break it down. FSDX is an actively managed fund, and it doesn't just hold stocks. It blends 4 main types of income-generating investments. First, U.S. dividend-paying stocks. These are high-quality companies that consistently pay dividends and often grow them over time. Second, preferred stocks, kind of like a hybrid between stocks and bonds. They pay higher yields and tend to be less volatile. Third, real estate investment trusts that generate income from commercial properties like shopping centers, apartment buildings, and office spaces. Convertible securities, bonds, or preferred shares that can convert into common stock. These offer some income with the potential for equity-like upside. So instead of putting all its eggs in one income basket, FSDX spreads risk across different sources. That's one of the big reasons I think it's worth being in my portfolio. If one segment lags, another might pick up the slack. Performance-wise, FSDIX has had some solid stretches. Historically, it delivered average annual returns in the 7% to 9% range over long periods, depending on the market condition. It's not meant to shoot the lights out, it's meant to be steady. And when the rest of my portfolio is taking swings, it serves as a comforting anchor. This fund pays me quarterly, just like SCHD. But it's not just about the return, it's about how the fund achieves that return. The income component of FSDX means an investor is not relying solely on price appreciation. They are getting dividends regularly, which, if reinvested, can grow over time through compounding. Here's how I think about it. FSDX is like a dependable partner in a portfolio. It's not trying to be flashy, it's just doing the work, generating income, reducing volatility, and providing exposure to sectors that often act differently than tech-heavy funds. The real kicker for me is its multi-asset strategy. In a world where most funds stick to one category, FSDX gives an investor a blend, and the fund's managers have the freedom to tilt the portfolio toward whichever segment looks more favorable at the time. That flexibility can be really useful when navigating changing interest rate environments, inflation, or economic slowdowns. Another thing that got me hooked is that FSDX is actively managed. That's not always my first choice. I tend to prefer passive funds for their cost efficiency. But in this case, I think active management actually adds value. The fund's managers can respond to changing conditions, reallocate quickly, and rebalance across different income-producing assets. Like I said, FSDX pays quarterly dividends, which I find helpful when planning for recurring income or reinvesting for compounding. That rhythm gives me something to count on, whether I'm taking the cash or letting it roll into new shares. And when I paired it with a higher growth fund like FNCMX, it started to form the kind of strategy I've come to love more and more. One that combines growth and income, excitement, and consistency. After I had the growth potential of FNCMX and the balanced income of FSDX in mind, I realized something was still missing from the bigger picture. Something a lot of investors tend to overlook, including me in the past. It's global exposure. That's where the Fidelity International Index Fund, FSPSX, came onto my radar. I'll admit, for a long time, my portfolio was heavily tilted toward U.S. assets. And why not? The U.S. market has been a powerhouse, but the more I studied global trends, the more I realized that not diversifying internationally can leave a big gap, both in terms of opportunity and protection. FSPSX is designed to fill that gap. It tracks the MSCI EFAE Index, which stands for Europe, Australasia, and the Far East. This fund gives me exposure to developed markets outside of North America, places like Germany, the UK, France, Switzerland, Australia, and more. So why does this matter? Well, first off, international economies don't always move in lockstep with the US. While the US might be going through a slowdown, other regions could be in recovery or even expansion. Having FSPSX in the mix gives me a natural hedge against economic cycles. That's a form of diversification I didn't fully realize until I saw how much smoother global allocations can make a long-term strategy feel. And here's what I found really astonishing. FSPSX has delivered competitive returns over the long run, especially when international markets are in favorable cycles. While it hasn't kept up with the US tech boom over the last decade, it has historically delivered average annual returns in the 6% to 8% range. That's the kind of performance that adds real value, especially when US markets are under pressure. Another point that really stood out to me is that FSPSX is passively managed and very cost efficient. Its expense ratio is low, which means more of my investment stays invested and less gets eaten up by fees. For a globally diversified fund, that's a huge plus. Now I want to be clear, FSPSX isn't the kind of fund you expect to wow you every single year. It doesn't swing for the fences, but what it does is anchor a portfolio globally. It gives me a seat at the international investing table without forcing me to research dozens of foreign stocks or worry about currency conversion. For me, adding FSPSX isn't about chasing returns. It's about balance. It's about recognizing that the world is bigger than just the S&P 500. And when I think long-term, 10, 20, even 30 years down the line, having a stake in that global growth feels like a smart move. So for investors like me who want to make their portfolio feel more well-rounded, FSPSX is one of the simplest ways to do that. It's not loud, it's not trendy, but it's steady, efficient, and quietly doing what global diversification is meant to do. Let's move on to the fourth and final fund, and it's one that taps into an asset class that's been creating wealth for centuries. Fund number 4, Fidelity Real Estate Investment. FRESX gives me exposure to real estate investment trusts, which are companies that own, operate, or finance income-producing real estate. Instead of buying a property, I'm investing in businesses that manage commercial real estate like shopping centers, apartment complexes, warehouses, office parks, data centers, and more. Here's what really caught my attention. By law, real estate investment trusts are legally required to distribute at least 90% of their taxable income to shareholders in the form of dividends. That makes them one of the most consistent income-producing assets in the market. And FRESX is designed to capture that. I like to think of FRESX as a behind-the-scenes income bees. It doesn't swing as hard as tech. It doesn't always match the flash of growth stocks, but it provides steady cash flow, often when other parts of the market are struggling. What I love about FRESX is that it focuses on quality holdings. I'm not getting exposure to random or speculative properties, but getting real estate investment trusts that own essential infrastructure. Industrial spaces supporting e-commerce, medical facilities, residential buildings in growing urban areas, and even digital real estate like cell tower networks and data storage centers. And here's a bonus I didn't initially consider. Real estate tends to perform well during inflationary periods. As prices go up, so do rents, and that means good income for real estate investment trusts, which can then be passed on to investors. So while inflation hurts some parts of the market, real estate can actually benefit. And FRESX is built to take advantage of that. Another reason I'm drawn to real estate in a fund like FRESX is the diversification benefit. Real estate doesn't always move in sync with stocks or bonds. That means when the stock market is zigging, real estate might be zagging, helping to smooth out portfolio volatility over time. It's also a more approachable way to get into real estate. I don't need $50,000 or $100,000 to buy a rental unit. With FREX, I can get started with whatever amount I'm comfortable with and gain instant exposure to a professionally managed pool of properties. One other thing I've noticed, FREX can also act as a psychological anchor in volatile markets. When everything else feels uncertain, seeing those real estate holdings, tangible assets tied to actual buildings and leases, gives me a little extra peace of mind. There's something comforting about knowing an investment portfolio is tied to the physical world. And it pays regular dividends, which can be reinvested for compounding or used as a cash flow stream depending on an investor's personal goals. For me, reinvesting has been a quiet way to grow the position over time. For me, this is a good way to bring real assets into a portfolio with built-in diversification, professional management, and consistent income. It's not a get-rich-quick play. It's not trendy or loud, but that's exactly why I like it. It just works quietly in the background, delivering income, reducing risk, and playing a key role in helping me build a long-term financial strength. Now that we've covered all four funds, let me show you how they actually fit together in a way that creates a balanced, long-term strategy, one that is less difficult to maintain, but surprisingly powerful over time. Combining these four to me feels like a modern version of the old core satellite strategy. It gave me different segments supporting different outcomes, but all working together toward one goal, a more complete and resilient portfolio. I'm not here to tell anyone what allocation they should use. That's where personal goals, timelines, and risk tolerance come in. But just to share how I think about it, I look at these four as pillars. For example, if I'm in my 40s or 50s and still focusing on growth, I might give more weight to FNCMX and FSPSX. Maybe even 60% to 70% between those two, with the remaining balance split between income, FSDX, and real estate, FRESX. But if I'm thinking about preserving wealth or approaching retirement, I might flip that, putting more emphasis on FSDIX and FRESX for consistent income and stability, with a smaller slice toward FNCMX for growth. I'm not saying this is the best or only way to invest, but in a world full of noise, this four-fund combo feels refreshingly focused. It's not about chasing performance. It's about building something durable, a portfolio that reflects where you're going, not just where the market happens to be this month. To me, that's the real edge. Having a strategy I believe in enough to stick with, no matter what the headlines say. The more I simplify my strategy and focus on funds that actually align with my long-term goals, the more confident I feel. I'm not trying to time the market. I'm not chasing the latest hot stock. It's a way I let my investments grow steadily while I focus on living and enjoying life at my own pace. That's why this four-fund setup made so much sense to me. Of course, everyone's journey is different. I'm just sharing what I've found helpful and what I've been leaning into more as I think ahead to the next 10, 20, or 30 years. If this gave you some new ideas or perspectives, I'm glad. That's what this is really about. Sharing thoughts, learning from each other, and making smarter decisions over time. I've also put together a playlist where I upload helpful videos on dividend and passive income. Feel free to check it out, and I'll see you in the next one.